This will be available as a podcast on all your favorite platforms, Spotify, Apple Podcasts, under that Lead Lag Live banner, as well as on YouTube. With all that said, my name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Lawrence McDonald, who I'm sure many of you have seen over the years, has some great research as well. I'm excited for this conversation. Lawrence, for those who are not familiar with your background, introduce yourself. Who are you? How did you get involved in markets? And what are you doing with some of your work?
Thanks, Michael. And I'm really impressed with the way you've grown this platform. And I like the leadership, and thanks for the leadership. I got my first break. We started ConvertBond.com in the 90s, and we sold it to Morgan Stanley in October of 99. So very fortunate timing there. And then I became, after that, I traded convertible bonds and distressed bonds at Lehman Brothers. I ran one of our large distressed businesses as a trader. And then as Lehman was heading toward the iceberg, I partnered up with Patrick Robinson, who had written Lone Survivor with the Navy SEAL Marcus Luttrell, became a #1 New York Times bestseller, and a movie with Mark Wahlberg. So I approached Patrick in the summer of 2008 about doing a Lehman book. And at a dinner party on Cape Cod around the 4th of July, he literally laughed in my face and said he was working on Shimon Peres's memoirs and he'd be busy until 2010. And at the dinner table, I looked at everybody around the table and I said, if this bank goes down, it's going to be bigger than Enron, WorldCom, Adelphia, and General Motors combined. And he sat there for a couple of minutes, said a Chivas Regal on the rocks. He put it down and he said, listen, if she goes down by the stroke of midnight, December 31st, 2008, you have a deal. And there are books now in 12 languages. It's a New York Times bestseller. It's voted by the CFA Institute as one of the top finance books of all time. So that's kind of where I'm. And now we run an institutional business with hedge funds, mutual funds, and pension funds. A live conversation every day on Bloomberg. So 80% of our revenue is from institutions, about 20% from higher net worth family offices, and we provide the Bear Traps report and the turning point.
All right, so I want to go back for a moment to you doing the distressed bond side of Lehman Brothers, which I'm sure was fun to do at that time. I've made this point all year that one of the most bizarre dynamics we've never really seen is this idea that we got to a point where government bonds were acting like the distressed bond, right? And you saw that with gilts in particular. I'm curious to hear your thoughts on how the volatility in the government bond market side has played out, if you believe it's justified or if it's an overreaction against credit risk, which still hasn't blown out.
Yeah, well, our next book is really, we just inked a deal with Penguin, and it's about the Lehman crisis was, okay, the banks were going down and the sovereigns bailed it out, right? So you took financial risk from bank balance sheets, and essentially you put it on the sovereigns and then sovereign governments. And then COVID, we took lockdown risk, which, economic meltdown, lockdown risk. And we took all that debt and all those social, safety nets that came out of lockdowns, and we put those on the sovereign balance sheet. And now we have a credit crisis around energy in Europe and even all through the United States, where families are being priced out, the bottom 50%. If you just look at Capital One credit default swaps versus, say, American Express, fascinating divergence there, very, very unusual divergence. And Capital One, remember, they really pitched themselves to the younger, to the little guy, the bottom 50%. So I think at the end of the day, you've got a sovereign crisis that's probably in the fourth inning globally. Then in the United States, you have a crisis where the bottom 50% has been hit by inflation, and just a runaway inflation that's really hurting families. And so the credit risk, if you just look at charge-offs at Capital One versus some of the other credit card companies, so you're seeing a real big divergence there, and kind of credit risk is kind of coming up to the system. It's not at Lehman levels yet, but it's the one thing about the high yield bond market and the investment grade market. The companies did an incredible job in 2020 and 21 of pushing out maturities, because it was so easy to issue bonds with the Fed doing that much QE. And so they've really pushed out the corporate credit risk for at least another year, but it's out there lurking for sure.
Yeah, as you say that makes me even think about the bifurcation that's probably already started in the housing market, I'm going to make the assumption that probably for a while, any real transactions in housing would probably be cash deals that don't come from obviously those kind of bottom 50%, to your point, because who the hell is going to want to buy a house when unemployment is set to rise and mortgage rates are so much more elevated than before? And it seems to me that the end result of all this is more of the same, meaning more of a widening of the wealth gap.
Yeah, it's the last summer I was on Nantucket, and it was insane. I mean, it was just and you look at the comments from United Airlines over the last like couple of months, and you just have a lot of Wall Street and financial people and any kind of executives are doing this kind of like they're spending more time in cities like Miami, like in other words, just traveling more and doing. It's not only are we commuting, further and like people are working less days in the office, but they're also have remote offices in better locations because COVID forced that, and a lot of those habits people don't want to give those up. So they're spending a ton of money on travel, and that's what's really kept up the economy over the last like couple of months. And one fascinating thing that's happening is if you think about Lehman, one of the things I talked about in my book is the Lehman shock, such a shock, and it created corporate America. It was in a fast mode to reduce employment. And same thing with COVID. So if you think about recency bias, right, in all of our minds, we had the Lehman shock and COVID, 14 years apart, but those are the two last shocks. And in both cases, what we call RIFs, reduction in force, RIFs, were very easy to execute. And so the employment situation relative to the market, relative to equities, was very fast transition into weakness. Whereas now we're like a 2000 to 2003 situation where there's been a large wealth destruction. I think it's like 18 trillion of bonds, crypto, ARK stocks, FANGs. It's a big number, and real estate. So you've got about an $18 trillion hit to the wealth, and that wealth effect, as Greenspan mentioned from 2000 to 2001. Greenspan not just mentioned, he wrote at great length about the wealth, what's called the wealth destruction impact on GDP, the wealth effect. And from 2000 to 2003, it was about 3% reduction in GDP, but it was very slow. And there's, companies, I think a lot of companies are laying off people, but they're doing it with severances. You get 2, 3, 4 months. And so that's why we're seeing this kind of magical employment market. The job market's holding up pretty well relative to the recency bias of Lehman and COVID.
And of course, one of the big drivers of the wealth effect is housing, right? And I always focus on lumber because average home has 16,000 board feet of lumber. That's been pretty weak all year, made even new lows on Friday. And what's amazing to me about how this bear market could play out, I said many times, I don't think the bear market in stocks ends until the bear market in housing ends. If you were to use lumber as a proxy for housing, which historically it's a pretty good one, you could fall another 50% in lumber prices to get to the bottom end of the historical range it's been at for decades. So it does seem like the reverse wealth effect is still going to keep going, but maybe be more centered this time outside of bonds, which, as you noted, is where the bulk of this year's losses have been. I want to focus on the word shocks for a moment, because I've made this point before, Lawrence, that inflation is more of a process, disinflation or deflation is more of an event, which is what a shock tends to be, right? Lehman was a deflationary shock. COVID was a deflationary shock for a moment in time. Do you get the sense that we're headed for maybe another shock, another deflation shock, just as everybody's still worried about higher inflation?
Definitely a consumption spending shock, like the savings, that's that large savings pool that's kept the economy up. By this time next year, JP Morgan just put out a good report, but we're coming down about 50% in terms of that excess savings kind of cushion that's been supporting the economy. And so this time next year, it's coming down quite violently. And so we'll have, I think the big picture for the like, let's think of like how we're going to make money for the next year, right? So to me, when you look at the dollar and you look at consumption, you look at the U.S. economy and the Fed, the dollar always has like 50% of the trade, and measuring what the dollar is going to do is the Fed and obviously the U.S. consumer, and the other 50% is the planet Earth. And so the planet Earth a year from today is probably in a better spot with China. And that's been a dollar tailwind this year. And so because lockdown after lockdown. But a year from now, that's probably a little bit of a tailwind for the other rest of the planet and commodities. And then you have Europe, the budget, which we'll get into, the federal budget is going to be interest costs are going to explode over the next year, and cost of living adjustments at Social Security in terms of paying people with Social Security because of interest because of inflation. That's about $100 billion. So there's not a lot of money for the Ukraine. Now they can try to front end load it in the budget at the end of the year, but the pressure on Zelensky is going to be spectacular to form some type of détente next year, because it's just the cash burn is too great. You just can't burn 50, 60, 70 billion every single year. And so Europe's probably in a better spot. And then at the same time, the U.S. is probably in a, because like what we're talking about now is with this consumption, excess savings is going to collapse over the next year, but close to $1 trillion less. And so that all sets up for, slightly weaker U.S., probably substantially weaker, but better rest of the planet. If that happens, then your dollar is, for the first time, it's losing all of its tailwinds, and the rest of the planet's got more of the tailwinds. And therefore, and if the Fed has to ease next year, if you look at Fed funds, they're starting to price in rate cuts. So if they're easing and the rest of the world's improving, that gets you a much weaker dollar, and that's going to help keep inflation up. So I just don't see that Lehman deflationary bust though that we had before. To me, I think there's more secular forces that'll keep inflation up.
I had this thought the other day that, in the event that Russia, Ukraine, the war stops and some kind of deal is struck, that I'd make the argument that could actually be seen as disinflationary or deflationary, and maybe could be problematic for the Fed, in the sense that any kind of hope that Russia stops means commodities come back, full force, or at least somewhat, from Russia. That puts downward prices on commodities, takes out some of the cost push inflation on the good side, against a Fed that's been hiking rates with that dynamic in the background. If the Fed were to pivot when inflation is still high, it seems like that's going to be somewhat of an optical problem for them, from an optics standpoint, right? Because they can't wait for inflation to go down 2% if there's broader disinflation, and they have to start cutting to get ahead of it.
Yeah, Michael. That's a great point on the Ukraine. I think there's got to be some massive truth to that in terms of, but to me, that's a 3-year trade from from the détente and how long it takes a resolution to actually get, start to bring things down, because there's just so much disruption every day, every week. But, the other factor is the Bank of Japan, where we have clients, and in the last month, I've had 4 big clients that have done these emergency flights into Japan. And Jens Nordvig was the keynote speaker at our conference, with our hedge fund conference in Panama. We had family offices and hedge funds about 8 days ago. He's seeing the same thing, where there's sneaky inflation in Japan. And so if you look at the planet Earth and all of the government bonds, right, and this real government bond yield stress, and you look at the Bank of Japan's doing yield curve control, the probability with Kuroda leaving in March, the probability of him kind of you think if you're Kuroda, and think if you're the Bank of Japan, you just watch the Fed embarrass themselves on the world stage by underestimating inflation, right? So if you're Kuroda and you got to protect your legacy on the way out, the probability that they alter or eliminate yield curve control in the first quarter, which would be a real big impact for the dollar, I think is very high. I'm hearing that from more and more clients. So that's it's the, like you said, it's the Ukraine war, but it's also other factors and that's a real tailwind for a weaker dollar.
Right. No, I think that intuitively makes a lot of sense on that end. But the thing that I think every policymaker is trying to control is ultimately volatility. And I've made this point before. I think people give too much credit to policymakers in their ability to contain gyrations. In many ways, they actually make the volatility higher from the actions that they take. But when we think about, just in general, where we are, I looked at your most recent report, and I love the analogy to 2011. I want to talk about how the debt ceiling drama, as you said in that report, plays out. There is a scenario, I think, that, and I've been saying this for a year, so admittedly I've been wrong for a while on this, that S&P could come in and downgrade the credit quality of the U.S. government again. A lot of people will say, well, that's not going to happen because the last time they did that, S&P got sued by the government. I want to hear your take on the debt ceiling and what parallels, if any, there are to 2011.
Well, thanks. And yeah, I want to bring this up because I spend a lot of time in Washington. Our partner is ACG Analytics since 2010, David Mester and his team. And we take the clients into Washington on a regular basis or work very closely with the ACG team. They advise hedge funds on policy. And it's a great indicator because I can see a lot of funds, a lot of hedge funds, mutual funds, pension funds, spending some time with ACG on this subject. And that means that it's something that's coming down the pike that we all have to keep an eye on. Because when the Republicans took the House in 2010, 63 seats, it was a powerful moment because it empowered the Tea Party to try to inflict some pain on the Obama budgets. And so now we have a House with a Freedom Caucus, right? And whether you're Republican or Democrat, this is a strange group of people, right? They're very powerful now because there's only a 5-seat majority, 5 seat. So the GOP has the House by 5 seats, but the Freedom Caucus has 45 seats. So in other words, the Freedom Caucus is going to be the new Joe Manchin, like in the sense that they have tremendous blocking power. They control the budget, and they're focused on like Tea Party type deficits. They're focused on interest. They're focused on inflation. And so, and last time in 2011, you're right, the U.S. was downgraded, but you remember the rating agencies are center left, right? They're more centrist. They're not Republicans or Democrats, but if anything, they lean a little bit more left. They would love to embarrass the Republicans by threatening a downgrade. And so the bottom line is the probability of some type of showdown in May, June is, I think, 80%. And if you're one of these Freedom Caucus people, these are more altruistic. It does seem crazy to put the credit rating of the United States at risk, but to them, they're looking at runaway inflation. They're looking at back-to-back $3 trillion deficits in 2020 and 21. And they're going to make a stand here. And the last point is the Fed. So the Fed keeps rates up here, Michael. For this is one of the dirty little secrets that's out there, like that nobody's really mentioning. And next year it's going to get tons of attention. If the Fed just keeps rates up here for 12 months, and you get Bill Dudley and all these guys, saying, "Oh, let's move Fed funds to 6%." This is the biggest crock of BS I've seen. Because if anybody just does the math, if you keep Fed funds here for a year, interest as a percentage of the budget, you think of non-discretionary spending and discretionary spending, interest as a percentage of the budget goes from like 8% to 11, maybe close to 12. So then it wipes out a ton of spending, and then it puts tremendous pressure on the budget for next year. So it's like, so not only are we going to have the debt ceiling, but we also have this interest as a percentage of the budget explosion.
I just put in the nest. So I'm with you on that. I put that out late September. The Fed is going to need to do QE just to pay for the interest expense from higher rates on government debt. I mean, that's why this is so bizarre of an environment. And all that probably results in presumably a deeper and deeper inversion in the yield curve.
Yeah, so exactly. So the yield curve typically would steepen as you come out of recession, and we're really flat. I mean, the 2s, 10s are at the flattest since Jimmy Carter. So you're really flat. When you go from one party in control, okay, to two-party control, in that first 3 to 4 months, typically you get a bond rally because of the austerity that comes in because of the Congress. So think if you go from one party control of the House and Senate to two-party control, the last like 70 years, you always get like a 50 to even 100 basis point rally in the long end because, and especially if that's around in a recessionary time, because you go from one party that's really kind of has control of the purse to two-party, and that kind of pressure and austerity gives bonds a rally, especially in a recessionary period. Now, so you probably get a rally, I think, the next 3-4 months, but then you get the Fed that's easing late next year. You get the economy's coming out of recession. You get the global economy is improving, and therefore you get that's where the curve really starts to steepen. And so I think it's like two trades. One is the first trade is You get double barrel tailwinds around going into recession, bullish for bonds. You go in from one party control to two party control, the House and Senate. That brings a lot of buyers into bonds. But then as we come out of this thing late next year, you get a weaker dollar, and then the long end is higher and the front end is, so your curve starts to steepen a lot next year. By this time next year,
Yeah, I mean, I can definitely see that playing out that way, and you're right. I mean, austerity is the best way to handle inflation, right? But it's also, you can argue, in a lot of ways, politically not really palatable. I mean, we're seeing that, right? I mean, a lot of government officials have been basically giving out checks to pay for inflation. But so it doesn't sound to me like you think that the Freedom Caucus is going to be that they are going to try to do everything possible to reverse some of the things that we've seen this year.
oh yeah, it's going to be a big showdown. They're going to try to keep the budget as, they're going to just, first of all, you've got, like I said, you got interest on reserves so after Lehman, we now have to pay the bank. So once again, if you keep the Fed funds rate up here for too long, you not only have the $100 billion of interest that has to go to Social Security, but additional, you've got the interest on the debt, and then you have another $200 billion of interest on reserves that has to go to the banks. So all in all, it adds up to like potentially a $500 billion hit. And so if you're in the Freedom Party, the Freedom Caucus, and Republicans, and all these bills start coming, like when Powell's on this Humphrey Hawkins next summer, this is going to be like a massive showdown, because people are going to, for the last 10 years on average, the Fed's been sending Congress every year 90 billion, 100 billion, 200 billion, but now there's this massive reversal, and where the Fed has this deficit within, because they're keeping the Fed's funds rate so high.
Let's talk about the idea of normalization, getting back to kind of a 2% annualized number. Nobody seems to be of the mindset that that's going to happen anytime soon. And I saw in your report, sort of the argument that you need much higher unemployment than people probably think to get to that level. How much of getting back to 2% is a function of austerity measures from the government versus the Fed forcing unemployment?
Well, there was a Wall Street Journal poll 2-3 weeks ago, and only 7% of the economists polled thought that Fed funds would be above 4% next year. So I think there's two things going on. I think you're right. I think everybody thinks inflation is certain to come down, but there's a large group of people that does think it's, like, people think it's going to, not to 2, but everybody thinks it's going to be below 4. Like 73% of the survey. So only 7% thought that we would have inflation above 4 this time next year. So I think that the power of labor, I mean, Marty Walsh is the labor secretary, right? I mean, you couldn't ask for a more important and powerful labor secretary to deal with this rail crisis, right? Because it's a Democrat. He's, has tremendous relationships with the unions. He's in the Biden administration. They can't get a deal done. And if you look around the country, Starbucks, the power of labor, what happens with inflation is it gets under the seat cushions. It gets into the cracks in the walls. In other words, when inflation hangs out once it goes above 6 and stays there for a couple of quarters, it gives people like labor unions and these leadership, first of all, they have more people coming into the unions because more and more people are really annoyed with inflation, and they need bargaining power because of inflation. So the ranks of labor goes up. Just a lot of the polls show that union membership and union popularity is as popular as the 60s. So you have all this like wage pressure but it's because of inflation. And once it gets in there, this rail strike is like it's happening like in multiple places all around the country. And that's what creates the sticky inflation. And so got that. I had Andreas Steffes invited. I went to Brazil, did a speech there with StoneX 2 months ago, and Andreas Steffes invited me to his office. Great guy, a billionaire. He's CEO of BTG Pactual. And I said, Andre, what does BTG stand for? He said, better than Goldman, better than Goldman. And we had some laughs, but he was a fan. He read my book, and he's like, listen, Larry, this isn't just reshoring. He said 30% of the entire planet is going to have a north-south supply chain of the company. It's going to have a north-south supply chain that will encompass. This is why the peso is so strong in Mexico, right? You've got a peso that is really strong in Mexico for the first time. Just look at massive breakout. And so that is, you've got Canada, US, Mexico, and then you have obviously Brazil. So obviously he's talking his book, but at the end of the day, this whole global supply chain has to be backed up to some extent, 20, 30% of it into this hemisphere. And so all of these things create, power of labor, new supply chain, all of these things create like some much more sustainable inflation.
But that probably also requires another debt binge, right? I mean, because you're going to need infrastructure, and we know infrastructure has been, horrible, and there needs to be a lot of investment in a lot of other places of the globe. So it seems to me that that's a bit of a stopping point, right? Which means you need to have rates lower to get the friendshoring and onshoring to really accelerate.
Yes, that's the wild card. Is exactly how much debt pays for. Like, well, we need this massive infrastructure build globally. There is no rail system in Brazil. So that country needs a rail system, and there's most of Latin America doesn't have a rail system. So that is a wild card that people haven't really calculated.
Let me reset the room for the remaining half an hour here. Everybody, please make sure you follow Lawrence McDonald. And again, if any of you want to come up and ask questions, click that bottom left mic request button. This will be a podcast under that Lead Lag Live banner. Let's go for a question.
Okay. You think back the last 2 months, we got this LDI situation. When you suppress the cost of capital for longer and longer and longer periods of time, there's an evil process that works in the markets. And this LDI situation is the perfect example, because when central banks suppress the cost of capital, and this is the pension funds that almost essentially blew up, the pension system of the United Kingdom was blowing up. And now we have a similar situation with commercial real estate in the United States and Blackstone this week. Look at Blackstone equity. I mean, they're putting up the gates, what we call gates, in terms of their large commercial real estate risk. So people want their money out. If they're gating, that tells me that whenever you see gates, and we saw these in 2008, that it's not just one cockroach, right? And so what I don't know is, how big is the commercial real estate risk when you suppress the cost of capital for 10 years? You enable under the surface all these jerks to create all these kind of derivative products that simply will, try to game the low interest rate system. And because the cost of capital is kept low for so long, that works for a long, long time. It's extremely profitable. And then each year, more and more of these games are played across not just LDI, but all kinds of different areas like commercial real estate in the United States. So what I really don't know is how big this problem is. Well, one thing that I get some pushback. So I look at M&T Bank. We had some clients that were short that. A lot of these regional banks were at all-time highs, even within the last 2 months. It was really weird, and it's you can see why in some ways, because the higher yields in the yield curve is so elevated across obviously 1 year treasuries, twos, tens. The whole curve is essentially, at one point it was like 4%. And for many, many years, banks haven't had that kind of beautiful curve to make money off of, because when rates are suppressed, extremely low levels, it's bad for banks. There's a whole bunch of complex reasons behind that. So this regime change in yields is somewhat bullish for banks. And so that's why it was really weird. Like 4 weeks ago, 5 weeks ago, we had, many equities at multi-year, like JP Morgan was at this. We put up a chart, JP Morgan versus M&T Bank. It was incredible. So it was the global banks, like the big banks that were exposed to the planet and the problems in Europe and all these kind of global problems were suffering, but the regional banks in the United States were at all-time highs. And when M&T reported, they alluded to some commercial real estate risks. So it looks like, to me, these regional banks have had this flight to quality because the global banks were exposed to Europe, exposed to China. And so if you have to own financials, which some funds, have to keep ownership of financials, right? So there was this massive crowding into some of the regional banks. And to me, the economic risk hasn't really been factored into to some of the regional banks.
I love that point you mentioned, Lawrence, which I think is spot on. It's like, you have a decade of low rates, an age of moderation, sort of the classic argument of, a little bit of a Minsky moment, right? A buildup of hidden risks using a combination of Minsky and Nassim Taleb in that way of thinking. And we have seen the biggest rise in rates in history. Now, for the most part, stocks have been, they've been in a bear market, arguably since February of last year, but you haven't, as everyone's correctly noted, had the flush. Now, I've made that point before that there was a flush in bonds, which is part of the whole reason for the initial melt up thesis on my end, which people can debate with me from here tomorrow, but it was a fairly sizable move since I said that October 2nd. But now, speaking about that point about the regionals and banks, it is curious to me, right? Because if you're going to have a recession, you'd expect financials to be among the worst performers. At least that's typically the case historically. It sounds to me like you need to have such a deep inversion in the yield curve that it's not profitable for the banks to lend to really stop the flow of credit.
Yeah, exactly. That deep, like if this, what we haven't seen in since such a long period of time, is where if you had this deep inversion stay here for long periods of time, and that's where, like, we haven't like every time the curve has been this inverted the last like 20, 30 years, it just hasn't been able to stay there very long because the Fed comes in and they usually cut aggressively. That's what we were talking about before. People don't understand, like, I haven't been calling for like a 2018 pivot, right? So I've been publicly around a pivot, but in the old days, a pivot used to be, okay, 2018, they were promising 5 rate hikes in 2019, and they essentially they ended up cutting rates, right, in 2019. That's a traditional pivot. What's happening now is they just did 4 consecutive 75 basis point hikes, 4, and then they were promising like essentially another 150 bips of hikes and all, like you said, 1 trillion of QT in 12 months. When you promise that much accommodation withdrawal and you promise that so aggressively, and you go out and you leak it to the Journal and you leak it to all these different Goldman Sachs, and everybody starts to believe it, the slightest walk back from that is a powerful pivot. And that's what's happening now. But it's not like a pivot that we've seen in the past. It's just that you're going from such aggressive accommodation withdrawal to, just a much slower pace.
And I keep going back to that point, and I'll get Michael Kramer in here in a second, but keep going back to that point that I feel like this narrative around pivot, that the bulls need a pivot, it's just not true based on history. The vast majority of times where the Fed funds rate goes negative is where you have the bulk of a drawdown in a bear market. Now, there are only 2 other instances in history where that wasn't the case, where the Fed pivoted after a big part of the drawdown took place. But whether a slowdown is a pivot or not, it's all about perception. The question is why is Powell walking back on the speed of rates rising when a month before he was ultra hawkish, and now it's like he's changing his tone and not much has changed, and if anything, the unemployment data still seems fairly strong. So there's a lot of questions, at least in my mind, as to what's really happening around Fed policy.
So most of my career, and we run, like I said, we run an institute. So anybody that's on Bloomberg, please reach out to us on Bloomberg because we can put you in the chat. But there's been this long assumption that the Fed has the jobs number, 2 to 3 days before, right? And that's been out there for decades. So this week, how on earth does Powell downshift, on the dovish side relative to expectations if he had the jobs number? It makes no
right. No, something doesn't. The sniff test isn't there on that. I agree with you on that.
And the only thing I can think about is when I was in Washington. I did a speech in Washington about 6 weeks ago, and we took some hedge fund clients around the hill, met with some people from Treasury, ex-Treasury people, and the amount of phone calls that have been coming into Treasury and the Fed from finance ministers around the world, because when the dollar is that viciously strong, you're exporting inflation, you're creating massive social unrest in the world. So the pressure on the Fed behind the scenes, and this is one thing they'll never admit that they were pressured into walking back the dollar. And then you have comments like from Elon Musk, and you just read Barry Sternlicht, and all these different smart guys. They don't know what they've done. Milton Friedman said, when you do 400 basis points of rate hikes in 7.5 months, like with this much leverage in the system, $50 trillion more than 2018 of There's like 300 trillion of leverage on the planet, but there's 50 trillion more than the last hiking cycle. So I think what's happening is they're doing the math behind the scenes, and they're looking at these comments and they're getting phone calls from guys like Musk, and they're getting phone calls from guys like Stern. Like, they're terrified that they've overcooked the porterhouse. And so,
and the IMF, right? It's more than just the business leaders. I mean, it's everywhere. And that's what, again, that's the end of the world case. Okay, I've made that point so many times. $300 trillion of government debt. You can't have your safe collateral that you're leveraging against be more volatile than that which you're leveraging. So it had to stop.
Thank you so much for those comments, and I'm glad to have everybody on the call today, especially with the soccer going on in the World Cup.
I told you there was going to be a melt up in the number of people listening to the space.
But so when I put that question in the chat to the institutions, I think there's so much short covering because the bearish sentiment was so off the charts, and this happens in deep bear markets where your year end, the losses are spectacular. You have a lot of funds that are on death row. If you're down 20%, if you're down 15, a lot of times you have to close up shop. So when you get that bad situation, that the hedges go on, dramatically, then all of a sudden on October 21st, there's this leak to the Wall Street Journal within the same half an hour of the Bank of Japan intervention on the yen. To me, that is just like, and all of this is just ahead of the midterm elections. It's just so, it smells to high heaven. And once people saw that, they just panicked and covered all at the same time. And yeah, so that's why in bear markets, you have this parabolic move that's typically short-lived. It's not healthy. Typically, in a bear market, you want to have a basing process and where the pain's been washed out. But this is like these parabolic, counter trend rallies that are, like you said, 90% short covering. And then at the same time, we did a chart this week. I'll share with Michael, but it's from 2000 to 2003. These parabolic rises in the industrials are almost identical today. And what happens is you've lost 7 trillion of wealth in the NASDAQ 100, 7 trillion. At least 2 trillion of that has gone into energy and industrials. And so what happens is, because it's a slow moving bear market that's not driven by a systemic event like a Lehman or a COVID, people have to stay invested, right? So then it's by year end. So I hate to say it this way. We have all these clowns, right, that wouldn't touch energy stocks, wouldn't touch industrials, right? But by year end, they have to reallocate their portfolios into these safer areas that are going to do better in an inflation regime. So it's like this massive crowding and running by the quarter end, year end. And to me, that's a pretty nasty setup for January, because it's just like everybody's crowding out in these safe havens. Yes, the board is definitely going into that dovish camp, but it's so unusual that this Brainerd speech was leaked also this week, and it actually came out in last year, and then they reissued the speech this week, and Brainerd's going to be a much more powerful factor. I mean, people like Brainerd, right? So more dovish, but there's a lot of progressives that want to change the 2% inflation target. If we're in a higher inflation regime, the probability over the next couple of years that the Fed has to raise the inflation target, and part of her speech was like all of these longer term challenges that the Fed, like the inflation target was really made for another generation, the 2% target. And so there's a growing conversation that I'm hearing from institutional clients and the Fed leaking some of these papers. There was another, John Turk. John Turk worked with our bear. He started with the bear traps. He's one of the best Fed watchers out there. John Turk. He's on Twitter. Make sure you follow John. But John's talked about this R star and R star number 2, and that's where systemic risk is also changing where the Fed stops. And so there's so much leverage. So at the end of the day, you get this new R star that's being leaked out. So the point is, you get the Fed's leaking all these weird things out to the public around a possible inflation target change at some point in the future. And then R star, where all R star means is the terminal rate is the point where the Fed stops, right? And what we learned with Lehman is that you can say whatever you want to say about the terminal rate and unemployment and the economy, but a lot of times the systemic risk changes that rate. And so that's what they call the R star number two. And that's essentially what just happened a little bit. Now, the Fed won't admit it, but this year, the Fed twice started to tone things down, right? And even though they made a very aggressive, they had a very aggressive hiking cycle, but they clearly, in the face of crazy inflation, they still kind of walked things back quite a bit with the economy at full employment, and they're probably doing that because of systemic risk.
I would add, I know you mentioned January, so I put out a whole big thread. The first time I ever did a thread like that on Twitter in all my years using Twitter. And I realized after the fact that I can't edit some of them, so I had to correct a couple of things afterwards. And a lot of people will point to the break in the dollar as being an argument for risk on in the near term. The problem is the dollar was really the only risk off play. Gold languished for a while, and treasuries, which usually are your best risk off trade, as we know, was worse than you can imagine. When I look at gold and I look at gold miners now, Lawrence, a nice move is starting to happen in that space starting early November. And gold does tend to act a little bit like so I see that. I see strength in treasuries. The dollar is not confirming it, but that just may be because it was the only game in town for risk off for a while. I don't know if you saw the thread, but I'm curious if you think there's any merit to the idea that maybe people are underestimating just how much of a risk the very, very near term could be. Because I do think the conditions are there for a surprise, akin to what we saw in 2018.
Well, if you look at the gold silver ratio broke this huge technical level in the last 5 days, and I've been watching it like a hawk because if it broke 80, it was a big deal, and it finally broke. It was like it broke 81. Really, so it typically that tells you that money's coming back, speculative money's coming back into metals, and it broke it this week. And typically, when you have a hard asset regime change, the gold silver ratio could go into the 30s or to the 50, way down the 50s. It's still up at roughly just under 80. So to me, that's a real signal that something big. Like look at Hecla Mining. That's one of our we do trade alerts for the retail financial advisors. So we've been buying this. It's one of our largest positions, Hecla Mining HL. But it's made this largest silver miner in the United States. And so you've got this big technical level. I think finally the Fed is softening a touch, but the global economy, because like we talked about a couple minutes ago, China reopening, and because of the social pressures there, their ability to keep that economy closed is fairly limited because they're at the breaking point. So you got that, and you got this whole situation with the Bank of Japan. So if the Fed is truly on, if the Fed's coming toward the end of the hiking cycle, at the same time that the planet's improving, that's just your best backdrop for harder assets. And the last 10 years, you want to be long financial assets, so growth stocks, and you want to be long bonds. And if we're really going to go to this new regime where inflation is, hangs out for 5 years between 3.5% and 6% and doesn't get down there, then people don't own enough hard assets. And then if the economy actually weakens, tax revenues fall. And like Michael said, then all of a sudden we have to go back to some type of universal basic income like we did. Essentially with COVID, we brought out universal basic income. There were just millions of families getting federal subsidies. And so if in a recession, we probably are in that problem again, where they're going to have to deposit money in people's bank accounts and the tax revenues are lower and your deficits are higher. And that's going to create a massive panic into harder assets. So yeah, I think that people are just starting to move into hard assets as an insurance, some hard assets. Other people have been in hard assets for almost the whole year in energy, but energy is so toppy that now precious metals are starting to steal some market share away from some of the other bubbly parts of the commodity cycle.
One of the main things around the 2008 financial crisis was the buildup of hidden leverage. Do you think that, because you kind of alluded to a little bit earlier, right, a decade of low rates and creates these kind of insane actors that take on too much excessive risk. Do you think there's there's a degree of hidden leverage? And where I'm going with this is in the cryptocurrency space. It seems to me that it's not impossible that you have a spillover into equities. I've made that point before. A margin call in one asset class is never just isolated to that. that one asset class. And a lot of people have been pushing back when I said maybe FTX ends up impacting equities with a lag, similar to how the Lehman bankruptcy impacted equities with a lag in '08. How do you think about hidden leverage risks here in what had been an insane environment for a lot of these cryptocurrency projects and scams?
Well, yeah, nobody's talking about this. I have a friend, he lost 30 million bucks in FTX. Okay. And you know what? There's so many of these wealthy guys that had this, they didn't sell their crypto. Well, they borrowed against it, right? So what people aren't talking about is how much GDP. Well, we know in like 2008, subprime and borrowing against your home and all that stuff, that was putting, at least is what I wrote about in my book, 75 basis points of extra economic growth in 2007 came from, using your home as an ATM and the financing. And so when rates started to go up, all those mortgages resets, and then all of that wealth destruction housing eventually crushed the consumer. The wild card is, there's something going on because the amount of wealth that was lost, not just the wealth that was lost, the borrowing against the crypto, that was fueling a ton of consumption. And that type of hit is nowhere near been priced into the economy. And so all that incredible wealth, right? That was, you could like, if you have $10 million of crypto, you could borrow $1 million on against it in 5 seconds and go spend it on a Ferrari, on whatever you wanted to, on a property in the Bahamas. And so that is yet to play out. And this is what I said earlier. When the dot-coms crashed, nominal GDP it fell 3% because of that wealth destruction.
Yeah, and it's markets. I think there's a lot of markets that are relate to chaos theory. So somebody will say to me, well, FTX is nowhere near as big as Lehman. Sure, but the whole point of chaos theory is that there are butterfly effects. A butterfly flapping its wings can create a hurricane. But the point is that it's not right away. The thing that really bothers me is that it was like within days after FTX filed that Treasury started looking and acting more risk off, meaning they were dropping in yield as stocks were going down. And I noted that November 16th. It's like something happened that day that spooked Treasuries. And it's interesting because it's happened. People are attributing the strength in Treasuries to the hope of a peak in inflation, which I don't necessarily disagree with, but I think there is something else that's happening in the return of the flight to safety dynamic. And it's just curious to me that it's happening with maybe the catalyst being FTX. And then to your point, nobody knows the extent to which it impacts so many other parts of the economy because of leverage then impacting other asset classes and sort of the negative feedback loop there. So I don't know. It's just, I look at that and I say to myself that it seems to me that you could have a delayed tail event. And just as everybody thinks that we're clear into year end.
And you know what's a great thing on that? Track the correlation between treasuries on the long end, oil and copper. And then if you look back, say the last like 10, go back 20 years. But if you look in periods where they are highly correlated and within the same 2-3 week period move violently together, we saw this just before COVID, right? We saw this around Lehman. And it's so, because those are to me the big three: oil, copper, and the long bond. And so what's been weird is you're spot on, like right around that right around the SBF blow up, all of a sudden the correlation on these three started right. It's one thing if bonds are rallying, right? But if bonds are rallying and copper, is selling off, and then oil is selling off in the same period, that tells you there's something much bigger going on. Now, the good news is this was happening 2 weeks ago, and copper's bounced out of that a little bit, and so is oil. But there was a period there, I think it was like within the last 2-3 weeks, where there were 3 or 4 days where oil rates and copper were all moving at the same very violent speed together lower. And you want to watch that like a hawk, because if that repeats in the market, that's one of your great risk indicators.
Yeah, also, I mean, it's funny because just on that thread, which looks like I got like 2 million impressions when I put that out yesterday. Again, people think I'm making a call. I'm not making a call. I'm saying the conditions are there. Just because it's sunny doesn't mean you won't crash. Just because it's raining doesn't mean that you will crash. But you have got to always identify conditions. The other part of this is also what's been kind of nagging at me pretty much all year, aside from the Treasury hell. The length of time with which lumber's been weak, the length of time with which utilities have been strong. Historically, especially when it comes to lumber, when you have weakness this unrelenting, it tends to happen prior to major declines, like major capitulatory declines in equities. So again, it's just there's just I was ultra bullish when everyone was ultra bearish October 2nd, but it just seems to me like something has changed, which I'd argue is a good thing, by the way, Lawrence. Right? It's like the worst thing in the world is an environment where everything keeps on correlating the same way except for energy. And at some point, energy goes through a nasty decline, and everyone then gets screwed because everyone chases at the top. To your point, right, about entering December. If you get to some kind of normalization on correlations, that's the first step to a healthier environment, one that at least you can potentially navigate through, as opposed to just being in cash, which is a guaranteed loss after inflation. Thank you, everybody, for joining. I'll have this as a podcast soon enough, and everybody enjoy the rest of your day. Thank you, Lawrence.